Welcome to the deep dive. Today, we are tackling a chemical sector puzzle that is incredibly challenging for investors.
Hmm,
Why is a company with rock-solid fundamentals getting absolutely battered on the stock market?
right.
We are diving deep into Clean Science and Technology Limited, or CSTL.
And this is such a classic conflict scenario. On one side, you've got CSTL, which consistently posts these, world-class operational metrics.
Like, what are we talking about?
We're talking 40% plus EBITDA margins and a perfectly clean zero-debt balance sheet. This is basically the gold standard for specialty chemical operations.
And on the other side,
Uh,
you have the market performance. The stock hit an all-time low of, what, 908.35 in November 2025?
A huge drop, and it's
Yeah.
massively underperforming the benchmark index.
Right. The Sensex gained nearly 8% during the same period, while this, supposedly elite company was just in free fall.
It really forces us to ask the question, is the market missing something fundamental? Or are the external headwinds just so powerful that they can temporarily destroy even the strongest balance sheet?
So to answer that, we have to start at the foundation, right?
Exactly.
Okay, let's unpack that good news foundation first. What is the core competency that even allows them to achieve those 40% plus margins?
It's not just about the chemicals they make, it's about the process. It's innovation.
Okay.
CSTL is one of the fastest growing and most profitable specialty chemical companies in the world because they don't use old, dirty, or, expensive processes. They develop these unique, sustainable, and super cost-effective catalytic manufacturing processes.
Well, that's their secret sauce, their intellectual property mode.
It absolutely is. This sounds like an R&D game, not just a volume game.
Hmm.
And it is. They have over 90 scientists working across 4 dedicated R&D facilities. This consistent commitment is why they can commercialize these unique processes.
Like for which products?
Things like MEHQ, which is a critical polymerization inhibitor, or for making guaiacol. And crucially, it's why they're such an export machine. 63% of their consolidated revenues come from global markets.
So they're selling these advanced niche products all over the world. Let's dig into that product portfolio. It looks pretty diversified, but what are the high-impact chemicals they're making?
So they structure their business into 3 key pillars, which sort of shields them from relying on just one industry.
Okay, walk us through them. What's pillar number 1?
First up, you have performance chemicals. This is really their bread and butter.
And what's in there?
Things like polymerization inhibitors and antioxidants. So MEHQ, BHA, TBHQ. They're used in everything from super absorbent polymers to food and feed stabilization.
So critical industrial ingredient.
Exactly. And CSTL claims global leadership in production capacity for a lot of these flagship products. They're often the biggest player in these high-demand niches.
Volume leadership in critical ingredients. That's a serious lever to have.
Correct. The second pillar is FMCG chemicals. This is more consumer-facing.
Right, stuff for consumer goods.
Yep. Including 4-MAP, which is a key UV blocker in sunscreens, and anisole, which is a precursor to perfumes.
Okay, and the third pillar.
That would be pharma and agro-intermediates. This includes products like guaiacol, which is used in cough syrup APIs and vanillin, and reagents like DCC and DHDT, which are used in antiretrovirals.
So they're really integrated across several high-value chains. That seems designed for resilience.
It is, and their processes, this all ties directly back to that Clean Science name.
You mentioned the margins. How much of that cost advantage comes from their operational discipline and their, ESG commitments?
A huge amount. When you innovate the process itself, you automatically cut down on waste and energy use, and that flows directly to the bottom line.
Makes sense.
They operate 4 automated facilities, and they all use a zero liquid discharge system.
And what does that mean in practical terms?
It means they treat and reuse all their wastewater. It's really expensive to install, but over the long run, it saves a massive amount on environmental compliance and input costs.
And they're pushing that further, right? I saw they have some pretty ambitious sustainability targets.
They do. They're aiming to cut specific water consumption, energy consumption, and GHG emissions all by 15% over 5 years, starting back in 2023. And 65% of their power is already from renewable sources.
So this is why analysts look at CSTL and see this structurally high-quality business.
Exactly. You've got a tech moat, product diversification, and operational excellence, all designed to keep those, legendary margins.
Okay, but if they're so superior, why is the stock collapsing? That brings us to the recent Q2 FY26 numbers. This is where that conflict between internal quality and external reality really crystallizes.
Indeed. Despite all that operational discipline, the recent report showed some serious revenue stagnation.
What were the numbers?
Consolidated revenue was 245 crore. That means growth was minimal, 1% quarter-on-quarter and only 3% year-on-year.
For a company that was once a high-growth darling, that's like hitting an emergency stop.
It really is, and their standalone revenue actually declined 7% year-on-year. That signals real volume pressure.
So what's driving that stagnation?
It's a bit of a perfect storm, really. A multifaceted global slowdown. You've got muted demand from key end user segments, just challenging macro conditions everywhere, and a really critical issue.
Which is?
Inventory destocking. Major global clients are just burning off existing inventory in this uncertain environment. They aren't placing big long-term orders.
You mentioned destocking, but I feel like the elephant in the room has to be the price war. How badly is Chinese competition hitting them, especially since CSTL is supposed to be the low-cost producer?
This is the absolute crux of the short-term pain. Chinese competitors are facing their own issues. Domestic overcapacity, slow global demand. So they've become incredibly aggressive on price. This isn't necessarily about them having better tech. It's about sheer volume dumping.
So they're just trying to clear inventory, even if it means selling at a loss.
Pretty much. And even the most efficient process in the world is challenged when a competitor starts selling below actual replacement cost.
Wow. Yet, despite all that, the revenue stagnation, the price pressure, the margin story is, well, it's kind of a miracle. How did they keep profitability intact?
That is the true testament to their R&D mode. Their EBITDA margins stayed incredibly high.
How high?
43.7% standalone in Q2 FY26. Management said this resilience was down to a highly favorable product mix.
So even if overall volumes were down, they were able to sell more of their highest margin, most specialized products.
Exactly, like the newly commercialized HALS series.
HALS, that's the hindered amine light stabilizers used for UV protection in materials.
Right, so they're pushing their most specialized stuff, but the volume drop and the pricing pressure are still overwhelming the net result.
And that pressure moves straight to the bottom line.
Straight to the bottom line. Consolidated profit after tax, or PAT, was 55.4 crore.
Which is a massive 21% sequential drop quarter on quarter.
And down 6% from the year before. That combination of fierce Chinese pricing and global destocking just hammered their PAT.
So internal quality,
Okay.
A+. External environment,
Yeah.
and undeniable F. And the stock market, being the short-term arbiter it is, has focused entirely on that F. This brings us to market sentiment and technical warnings.
And the stock chart just perfectly reflects all that fear. The primary trend has been a textbook downtrend since late 2021.
A classic pattern of lower highs and lower lows. Pessimism is just deeply entrenched.
Deeply.
So what are the red flags the technical analysts are pointing to? What's the psychological line in the sand that the stock needs to cross to regain confidence?
The price is currently trapped way below its long-term averages, specifically the 50-week moving average.
Which is where?
It's sitting around 12,250, and that's acting as this massive psychological and, dynamic resistance. For investors, until the stock can consistently close above that 12,250 level, any rally is just viewed with a lot of skepticism.
It confirms that long-term bearish momentum.
Exactly.
And what about those huge down moves in late 2025 when the stock hit that all-time low? They were on soaring trading volumes. What does that kind of volume spike tell us?
That's what's often interpreted as capitulation selling. It's not calculated. It's panic.
Forced liquidation.
Right. It signifies that even major investors who held on for years are finally throwing in the towel. This massive volume near multi-year lows suggests that sellers are exhausted. But the lack of institutional buying support means the price just hasn't found a floor.
But when selling pressure is that intense, doesn't it often lead to an eventual bounce?
Yeah.
At some point, there are no sellers left.
It does. And the technical indicators are deep in oversold territory. The relative strength index is way below 30.
So it's technically due for a short-term bounce.
It is, yeah, a corrective rally. But, and this is a big but, here's the caution. Until the company can show a clear volume ramp-up, any bounce is likely just technical noise.
A dead cat bounce.
Exactly. It will probably hit a ceiling of selling pressure right around that 1,250 level. The bearish structure is demanding operational proof.
So the market wants answers. It wants a clear path forward. The company has these incredible assets, zero debt, massive margins, R&D competence, but it's facing these immediate volume and pricing issues. What is management doing right now to bridge this gap?
This is where we get into the strategy for turnaround and future growth.
Okay.
They're playing the ultimate long game, which is the luxury you have when you're debt-free. They're using their healthy cash reserves to strategically invest in future growth while the external environment is weak.
And while the stock is cheap.
And while the stock is cheap, the core strategy is diversification into new, high-value, high-barrier-to-entry products that can replace that lost volume.
Let's get specific. What are they building?
3 key growth drivers are on the horizon. First, they just commercialized the largest plant for HALS in India back in 2024.
Right, the UV stabilizers.
Owning large-scale, cost-efficient capacity for that is a massive differentiator. Second, chemical trials for a new high-value Performance Chemical 1 are well underway. And third, construction for Performance Chemical 2 is firmly on track.
So they're betting their R&D pipeline can solve the volume problem. And these are all products where their proprietary process advantage will be the strongest, so they should be able to keep those 40% plus margins on these new lines, correct?
Precisely. They're leveraging their unique catalytic abilities. And what's more, this heavy capex is perfectly timed to coincide with the much-anticipated recovery in export markets.
So while the near term is murky.
Right, visibility is capped by destocking and pricing pressure, but the medium-term outlook is incredibly optimistic.
What kind of growth are analysts predicting once these new plans actually scale up?
The consensus forecast is projecting revenue and earnings growth to rebound significantly. We're talking 20 to 21% per annum.
Wow.
And that projection is underpinned by their robust margin structure, the active R&D pipeline, and, the expectation of stabilization in their key export segments.
And this all ties into that huge sector-wide tailwind everyone's talking about. China +1.
Absolutely. The entire Indian specialty chemical sector is expected to grow at 9 to 10% annually over the next 3 years, partly because of this global trend of supply chain diversification away from China.
And CSTL is perfectly positioned for that.
I think so. Given their status as a proven, high-quality, reliable exporter with ISO certifications and ZLD facilities, they're perfectly positioned to capture significant market share when global procurement managers decide to diversify their sourcing.
So to summarize this for you, the listener, this deep dive really reveals a fundamental dichotomy. On one hand, you have CSTL, a company with these internal, rock-solid metrics, tech leadership, zero debt. But it's battling these intense external headwinds, Chinese price dumping, global destocking, that have just completely crushed its stock price.
The quality of the asset itself is undeniable. The success of the turnaround really hinges on the timeline, the speed at which their strategic capex, the new HALS capacity, the upcoming Performance Chemicals 1 and 2, the speed at which that scales up to overcome the current volume stagnation.
It raises a powerful question about value versus momentum, doesn't it? Given that the stock is so technically oversold and sentiment is in the basement, the market appears to be completely ignoring the company's massive underlying R&D competency. 90-plus scientists who pioneered these processes.
Can that short-term market sentiment and technical analysis hold up indefinitely against a company that's actively building the world's largest capacity for flagship products while sitting on 40% plus margins and zero debt?
Or is the market just waiting for that first definitive quarter of volume ramp-up before it corrects this deep technical discount and recognizes the intrinsic value of this specialty chemical powerhouse?
And that, right there, is the fascinating long-term bet currently represented by CSTL.